credit is going through a real moment right now where returns are very interesting across the liquidity spectrum, private and public. But a lot of what's driving this change, especially in the private markets, is what's happening with banks. And so the way that we think about it, and I think in some of the slides we talk about it, that there's a fundamental retrenchment of banks going on right now that is different from how it was over the last many years. There's a change right now happening that's since what happened in 2023, the collapse of the regional banks. So what we've seen is that it's not just regulation. The story for a long time was regulation and tightening of regulation, and that is still at play. But what happened in 2023 was not regulation, it wasn't a lack of capital, it wasn't credit problems and balance sheets, it was interest rate volatility. And that interest rate volatility drove an extension of the duration of assets on bank balance sheets, and it drove a decline in the duration of liabilities on bank balance sheets. And so you have this asset liability mismatch that is chronic in banks. And so banks have really taken a look at that and said, how can I work with this? How can I work in a higher interest rate world, a more volatile interest rate world that optimizes the balance sheet? And so you hear this buzzword of balance sheet velocity. And what that means is a move from originate to hold on balance sheet to originate to distribute. Hold some on balance sheet, but look for partners outside of the banks. And that is the opportunity for asset managers and ultimately the opportunity for investors all over the world. And if we go back on that slide that we just had, what we see is that in 2022, before the collapse of the regional banks, you had very high growth in bank lending. And what's happened in 2023 and 24 is that bank lending has collapsed. That bank lending as a share of GDP is declining, and you see outright declines in nominal terms in regional banks. But interestingly, what's happening while this is happening is that banks, while they're not really willing to hold a lot of their residential mortgages on balance sheet, their consumer loans on balance sheet, their equipment loans on balance sheet, aviation, infrastructure debt on balance sheet, they are willing to lend against those loans. And so the one area that's been growing at banks is loan on loans, NAV lines, subscription facilities, things like that. That is a huge growth area for banks, and it's a huge opportunity for asset managers and ultimately investors as this move of credit out of the banking system into a much more balanced, much more hybrid world of banks, asset managers, and other non-bank lenders. So for us, very much so in the US and in Europe. In the US, mostly debt. In the US, mostly private IG transactions to help some of these IG companies keep this debt off of the balance sheet. Very interesting pickup to the liquid credit, but you have a look-through guarantees from these AA, single A, AAA borrowers. In Europe, we're actively investing in construction and development of data centers in tier 2 markets, which is really one of the most interesting development markets in the world right now because it's underinvested, it's difficult to invest in. The hyperscalers, the big tech companies don't want to do it themselves because it is very complicated to get the land, to permit the land, to get the power, to pull it all together. And so that's where there are some returns to the complexity of the opportunity. So there we're very excited about that. I'd say two major and really radical transformations that we've seen in recent years. One is, and Mike, you mentioned it, I mean, there's the liquidity in credit markets. I mean, you mentioned that once upon a time it took 2 months to trade a public corporate bond. Today, with the rise of the all-to-all platforms in liquid credit, you can sell those bonds in 2 seconds. The liquidity in IG credit is unlike anything we've seen in our careers, and facilitated by technology, moving outside of the banking system into these technology platforms. So that's a radical change which has really facilitated the liquidity in this market. There are really interesting illiquidity premiums in private IG as well, but I think it's important to recognize just how strong liquidity is in credit markets. Now, the other thing is that rise of asset-based finance, but particularly in the global spectrum. And so what we've seen in the last couple of years is a move from asset-based finance, which was really a US phenomenon, now very much a European phenomenon. As European banks, as European governments realize that they need more diversified credit sources, looking at areas outside of banks, asset managers, non-bank lenders, et cetera, to provide that asset-based finance. So that is a fundamental transformation that's happening right now. We've deployed at PIMCO several billion in Europe in asset-based finance over the last couple of years, and we think that there's a lot more growth to come in the years ahead.